Invicta, the industrial company, recorded a 39% jump in full-year earnings per share to 6.87 cents. Revenue grew 24% to 5.6 billion rand. The company cited organic and acquisitive growth in two of its largest contributors to the group, which both succeeded in doubling revenue over the last 5-year period. We're joined now for a look at Invicta's result by CEO Arnold Goldstone, and he's got more for us on these numbers. Arnold, I've always say if your revenue is up, say, 24% and your earnings are up by 38%, that's quite a big gap between earnings and revenue, and it's a positive one. It means you're doing something right. So what was it that went right for the company in this period?
Thank you. We focused heavily on our cost side of the income statement. And as a result, we were able to get that, what I call operational gearing. Our gross profit percentages remained almost flat, but because we had a greater contribution at revenue line, that translated into bigger gross profit rands, and with good cost control resulted in a better earnings figure than the revenue lift.
You say astute management of costs. In one respect, your business seems simple. You know, you're providing tractors, for example, and we'll talk about the revenue in a moment, tractors to the agricultural industry. The other business is very much an industrial, exposed to mining and construction and so on. How do you astutely manage costs in these times?
Well, I think the answer is to always be aware of your cost structure. You know, it's so easy to build overheads with almost unconsciously. You know, you add a few people here, add a few people there, and if your vision is always on the long term, or your focus is always on the long term, there is a danger that you slip into the habit of increasing your cost for the long term, but the revenue doesn't match that. So we try to strike a happy balance between building the infrastructure and the capacity to grow our revenue line, but not overbuilding. And you know, markets come and go. As you know, it's one thing is sure, markets go up and down. It's just a matter of getting the timing right. So we always are very conservative in our approach, and that maybe goes back to our early days as an agricultural machinery business. That was the core of our business some years ago. It no longer is the core, but it's a big part of it. You know, we learned to live with droughts, so we would always be careful of building overhead structures. So that's really what we mean by astute management. And the contrary to that is also on the balance sheet, is to watch the working capital cycles, make sure that we get that equation right.
Well, let's look at your two major divisions, the capital equipment group. You say there's been a surge in demand for agricultural equipment, in particular tractors. Yeah. Grain prices high. Give us a picture of, more broadly, of what's been happening in that sector.
Okay. If you take the tractor sales year-to-date May this year, which were released this morning, they may not be public knowledge yet, but the tractor sales are up about 30% on last year equivalent period. If you look month on month, they're up, and if you look year-to-date, they're up, which is largely a result of the strong grain prices. The biggest consumer of tractors in the country is the grain industry. That's maize and wheat. And our interpretation of events is that the farmers have had good yields. The grain price has been pretty strong over the past 12 months. It has tapered off a little bit, so there's a bit of a softening. But generally, the farmers have had a good inflow of cash over the past 12 months, and that makes them eager to replace tractors. The tractor market, the bulk of the tractor market, about 60% of the total volume in the market, is under 100 horsepower, and that's a small tractor. You know, for those who don't know what a tractor size is, but so you can see it's almost like the commodity end of the tractor world, which represents the units. So far, the sales look pretty good for this year, and you know, our concern as a group is that the grain price has softened a little bit. Farmers' input costs will go up with the softening or the weakening of the rand, the recent weakening. So we're just watching that space.
Let's look at the other big division, which is called BMG, and that's contributing 59% of operating income. Conditions in that sector?
Yes, that sector, it's really driven by resources. You know, our group, as the BMG or Bearingman Group, services industrial South Africa. So it depends on one's view of industrial South Africa going forward, but historically it's been a good space. There's been good demand for resources from around the world, which has driven demand for mining in South Africa. And that is a big contributor. Also, the soft commodities like grain is also one of the commodities that has an effect on the BMG business. Sugar, you know, those kind of products that require milling in the instance of sugar. Steel prices, for example, do have an influence. We service the steel mills. So the whole of industrial South Africa is serviced by BMG. And that has been in a fairly good space. We've also had acquisitions that we made in the prior year, so not in the current year, that may have only contributed a month or two or portion of the year for the 2011 results, and this year have contributed in full. So I think the secret of our success in that business is it's what I call a smokestack industry. It's an unsexy industry if you want, but it's essential for the normal day-to-day activities of industrial South Africa. And although if you look at the industry stats, they indicate a kind of a flattening off, we've been able to steal market share in certain instances and also grow our base quietly, and each year we just add to that base. So, you know, we kind of make sure that we attend to our sort of old businesses, if you want, but also make sure that we grow that base.
Just talk a bit there about the acquisition and to what extent these numbers, if they were like for like, would look the same, and what difference has it made to the scale of your business in terms of the mix of business now?
Okay, for the current year, the acquisitions made during the current year, so the 2012 financial year, have only contributed about 70 million to revenue, which is 2% of our revenue. So it hasn't been a material contributor in this year, the acquisitions that were made during the year. But if you go to the acquisitions that were made in 2011, and then see to what extent they've bolstered the revenue figures this year, that figure is materially higher, probably of the order of about 200, 250. I just don't have the figures right in front of me, but it's that kind of order. Oh. So, you know, it's a 5 to 7% increase in the turnover. Had we not made those acquisitions in 2011, our turnover would have been 5 or 7% lower. Oh. So it adds as one goes over time.
Yeah, but clearly the results did not depend on those acquisitions. You make an interesting comment, Arnold, in your statement. Now, you've said how the agricultural and the industrial engineering areas were good for you and so on, and then you say the group is concerned about the lack of investment in mining and related projects in South Africa and the apparent deindustrialization of the country. Now, that kind of leaps out at one in the context of what is really a more formal, conventional kind of results, good results presentation. The apparent deindustrialization of the country, you sound worried.
We are concerned, you know, and each month we have industry stats that come out, you know, the PMI index, which measures, call it factory activity in South Africa, is quite volatile. And our experience is that if you take a factory, it takes years to build up a factory that is effective and productive, etc., and efficient, but it takes a month or two to shut it down. But if you shut something down and you need to resurrect that factory, it will take you months, if not a year to year and a half, to actually get it back on stream, get people online, get your material flow right, and get your product out the door and into the market. So our concern, and if one looks at the textile industry in South Africa as a case in point, is that once those factories shut down in South Africa, they're probably lost to South Africa for good. And we are aware of a gradual decline in the production capacity in South Africa at factory level. And it is a concern for us. It's probably fair to say that our labor isn't as effective as perhaps in the rest of the world, as cost effective. And hence there's this big migration worldwide, in fact, to production out of Asia. So we are aware of that. And also, at the other same time, the investment in mining. It's known that investment in South Africa in mining is non-existent. The production coming out of mining in South Africa is at the lowest in years and years. So, and yet when you travel the world and we speak to our suppliers and wherever we go around the world, we find that there is big investment going into mining, but not in South Africa. Rest of Africa, parts of Asia, Australia, you know, they have a boom in Australia in the mineral industry.
Which also
we're not experiencing it. So we're just issuing a word of caution. We've had a wonderful run, especially on the BMG side, which is really exposed to that sector. But we're just issuing a word of caution to our stakeholders to say, be aware of the backdrop. And at the same time, we're not, accepting it with a defeatist attitude. We're saying that is the reality. We can't change that in South Africa. So we are looking beyond the borders of South Africa to kind of give us a better balance.
So that would explain your comment about the board being optimistic and confident of continued success, because it's slightly contradictory in the line of what you've just said. You also talk about weaker grain prices resulting in lower demand for the other division. So it's a bit of a mixed signal, isn't it? And I suppose it also tells us what some of the other companies that are exposed to mining and so on can be doing in a while, because they've had some good results recently. So on balance, you're optimistic but cautious.
Absolutely correct. We'd rather under-promise and over-deliver. And our whole modus operandi has been to be conservative in the way we run our businesses, but ambitious with our growth targets. And we recognize that within South Africa, the environment, the backdrop in which we operate, may be a little bit more stressed going forward than we have had in the past 12 months. I'd love to say that we expect conditions to remain buoyant and to keep growing, but the factors are slightly different, and we just want to make everybody aware of that. But we're optimistic, no matter what.